Hey, welcome back, options traders. And I thought it would be helpful for the group to talk about a little hidden benefit of debit spreads. And that's if you get assigned early, because so many traders just talk so much about the credit spreads. They love credit spreads just because of the word credit. But as I've talked about in so many videos, take any strategy, any combination, and there are always trade-offs. There are benefits and there are drawbacks. Same is true here for debit spreads and credit spreads. But there's a hidden benefit that a lot of traders overlook when making their decisions. So what is it? Well, let's go take a look at an early assignment benefit for debit spreads. As always, before we get started, if you could, please click like. It goes a long way in promoting the channel and is definitely most appreciated. So let's start with the debit spreads. Let's say that you buy the 100-105 call spread. That means you've purchased the 100, you've sold the 105. And let's say that it costs a net debit of 3. And of course, the most you can make is the difference in strikes, or in this example, 5 points. So if you paid 3, the most you can make is 2. But the question we want to ask now is, what if you get assigned early? Is that really going to pose a problem? What's going to happen? Well, let's take a look at the vertical spread first. So we are on this blue curve. This is our risk graph. There's our long 100 call. There's the bend right there at 105 for the short 105. Here's our maximum loss, $3. Here's our maximum gain of 2. Now notice that we are bullish. We need the stock price to rise to get us into this maximum gain. Also notice that if the stock price falls, it could push us into maximum loss of 3. But one of the key things to note is that this blue line is at expiration. That's why it's called an expiration graph. And that means that these values, this positive 2 and negative 3, only apply right on the closing bell on expiration day. So to get this $2, we need the stock price to be above 105 at expiration. But if we get assigned early, something interesting changes. What's going to happen? Well, if we get assigned on the 105 call, it just vanishes, gone from our account. That's what happens on an assignment. But if you don't have the shares, you are going to sell 100 shares. Too many times new traders say, well, if I get assigned, they're going to take my $100 call. No, they're not. The exercise is always for the shares. But in addition to now having short 100 shares, you still have this long 100 call. So you're going to be left with minus 100 shares, or short 100, plus the 100 call. And that is a synthetic long $100 put. This put will have the same strike as the call that you own. Now, if synthetic options are something new to you, you'll want to go back into some of the archives in this channel and take a look at synthetic positions. But the interesting thing to see is that the moment you get assigned, the very second those short shares hit your account, you move from the blue line to the red. And the first thing that jumps out is you now have a guaranteed $2 gain. And that's because you own the more valuable strike. See, you own the $100 call, and lower strike calls are always worth more money. They give you the right to buy shares for less money. But we absolutely positively know that you just shorted shares at 105. See, when you were on the blue line, when you initiated the position, you didn't know that. You'd have to wait until expiration to see if the stock is at 105 or above. But the very second you get assigned, you have now for sure sold shares at 105. And with the right to buy at 100, there's your guaranteed 5. You paid 3, there's your guaranteed 2. But we've done something else. We've changed the directional bias here. We can actually make a profit if the stock falls. See, on the blue curve, we didn't have that benefit. If the stock price fell, we were pushed into maximum loss. But now, not only do we avoid this loss, we could actually make money. So it's as if the person that exercised the call gave us a free lottery ticket. We have our guaranteed 2, but you know what? We might make more if the stock price falls. So this is really the big benefit of the debit spread, is that if you get assigned early, you are going to lock in those gains instantly, and also handed a free lottery ticket if the stock reverses course. So that's another thing about the debit spread. It will change your directional bias. We were bullish on the blue curve. We've now switched to bearish on the red. That could be a good thing. It could be a bad thing. But this is one of the things that you have to decide when you are initiating the strategy. If I get assigned, do I want to stay bullish, or would I maybe like to switch to bearish? Would I like to lock in the gains, or would I like to still chance it, but keep my directional bias? These are things that new traders never, ever consider. So now let's go compare that to the credit spreads. And we're going to compare the credit put spread to compare apples to apples. If you sell the 100-105 put spread, you will also be bullish. And so if the spread that we just saw cost 3, theoretically the corresponding put spread should be selling for a credit of 2, but this is a liability equal to the difference in strikes. Notice that you are long the 100 put and short the 105. And because you're short the 105, you might have to buy shares for 105, and you have the right to sell them for 100. Well, that's a $5 loss. That's all this put spread is a liability. And again, that doesn't make it bad. It's just that when people hear credit spread, they think that they are getting paid to take an asset. And that's just simply will never, ever happen. You are getting paid to accept a liability, in this case equal to the difference in strikes of $5. So if you were paid $2 and you end up losing 5, your maximum loss is actually 3. Exactly what we just saw. But what happens if you get assigned early on this deal? Well, when you sold the 100-105 put spread, this is your risk graph in blue, and it is exactly what we just saw with the debit spread. We have a maximum gain of 2, max loss of 3 at exactly the same strikes. But if you get assigned early, you're going to get assigned on this short 105 put. It vanishes from your account, but now you're going to be long shares. Remember, the short put gives you the obligation to buy. So if you are long shares, you still own this $100 put down here, and that is synthetically a long $100 call. So you are bullish on the blue curve, max loss of 3, max gain of 2, and the moment you are assigned, what happens? Well, you move from the blue to the green. So the first thing that jumps out is that yes, you do unlock the potential for more gains. It used to be limited above 105. That's why this blue curve flattens out. But look at how it's been unlocked. Now you can make an unlimited amount if the stock price rises. But also look at your maximum gains and losses. They haven't changed. And that's because you own the less valuable put. You just bought shares at 105. You have the right to sell at 100. That's still a $5 loss for which you were paid $2. The max gains and losses didn't change. And this is one of the things that traders often overlook. If you get assigned early, yes, you do get a benefit that you unlock these upside gains. And potentially another benefit is that you stay to the bullish side. So notice that when you get assigned on a credit spread that you don't change your directional bias. So once again, that's not necessarily bad. It's not necessarily good. It's just something that you need to address while you are deciding between a debit spread and a credit spread. But probably the bigger thing to take into account is that with the credit spread, you also don't lock in any gains. This is the hidden benefit of the debit spread. See, too many times traders say, well, I did the credit spread, and that way if I get assigned, I'm still bullish. Well, okay, that's true, but you haven't changed any of the gains or losses. So that's really a big hidden benefit of a debit spread over a credit spread. That is, again, if you get assigned early, you are going to lock in that maximum gain. And so if you're not taking things like this into account when you're setting up your strategies, or in this case with a vertical spread, you are not using your options and your strategies to their fullest potential. And that can only mean that at best, you're going to have mediocre results. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the YouTube channel, Options A to Z Facebook Trading Group, and you can find a link in the description below.